Why is inflation so high? High inflation isn't going away. In fact, prices are going up at their fastest rate since the early 1980s. Prices rose 7.5% in January compared to the year prior, according to the most recent Consumer Price Index (CPI) report. This is the biggest annualized growth in CPI inflation since February 1982. When you strip out volatile food and energy prices, so-called core CPI, the picture was still grim. Core CPI rose by 0.6% in January, and climbed by 6.0% over the last 12 months, the largest gain since August 1982. Controlling inflation is one of the main tasks of the Federal Reserve. The January CPI inflation data serves as yet another reminder that the Fed has more than enough reasons to start raising interest rates and tightening monetary policy. "I think the Fed will raise rates 3 to 4 times this year," said Larry Adam, Chief Investment Officer at Raymond James. "I think the Fed will raise rates 3 to 4 times this year." Elevated inflation has been driven by supply chain disruptions and pent-up consumer demand for goods following the reopening of the economy in 2021. Should these issues resolve themselves, the Fed may not have as much work to do on the inflation front as some fear. High inflation is sticking around. The high rate of inflation in January was driven by big gains in food, electricity, and shelter, according to the Bureau of Labor Statistics, BLS, putting further pressure on the bottom lines of average Americans. Energy prices grew yet again, with total prices jumping 0.9% from December, while the 12-month gains are still an astounding 27%. Gasoline prices dropped 0.8% in the month, but are still 40% higher than a year ago, while fuel oil rose 9.5% in January alone. The numbers dovetail with a recent survey by Fidelity's e-money advisor, which found that the high cost of gas prices was the #1 concern for Americans, followed by being able to pay bills and inflation overall. "There's definitely a lot of financial anxiety," said Celeste Ruvelli, a director of financial planning at e-money advisor. "There's definitely a lot of financial anxiety." Certain items contributed mightily to these historic gains, as any driver can attest. Prices of used vehicles are up nearly 41% compared to 12 months prior, food is 7% higher. Shelter costs have risen by 4.4% during the same period. When you strip out volatile food and energy prices, so-called core CPI inflation, the picture, while somewhat brighter, still shows price gains not seen in almost 40 years. That figure jives with the Fed's preferred inflation gauge, core personal consumption expenditures, PCE, which gained 6.1% in December compared to the year prior. Both findings are well above the Fed's 2% target. Inflation is enemy #1 for the Fed. The Federal Reserve has two jobs: keep inflation under control and maximize employment. Fed officials took their time acknowledging that renewed inflation growth would require a sustained monetary policy response. But over recent months, they've recognized that rising prices won't be transitory and could be a major threat to the labor market and the rest of the economy. High inflation is a severe threat to the achievement of maximum employment, Fed Chair Jerome Powell told the Senate Banking Committee on January 11. To deal with inflation more forcefully, the Federal Open Market Committee, FOMC, moved up the end date for its quantitative easing bond purchases to March. The committee has also put markets on notice that it will start selling assets from its tremendous balance sheet later in 2022. The first rumblings of this so-called quantitative tightening (QT) plan helped spark a 5% decline in stock markets in January. With bond purchases over very soon, the Fed is expected to raise the federal funds rate after their March meeting. This would be the central bank's first rate hike since the end of 2018. The Fed could raise rates a total of 5 or 6 times this year, according to the CME Group's FedWatch tool. This is a big change in tone for the Fed. Throughout 2021, Powell and other Fed officials branded inflation as transitory and asserted it would take care of itself as pandemic supply chain bottlenecks and other problems associated with reopening died down. Should you be worried about high inflation? Folks are definitely feeling the pinch. Consumer confidence took a nosedive in the January 1 survey, recording the lowest reading in almost a year, while the University of Michigan Consumer Sentiment Gauge has likewise fallen to near post-pandemic level lows. That's for good reason. While wages are still gaining, they're growing at a slower rate than prices overall. In fact, inflation-adjusted earnings dropped 1.7% compared to this time last year. That means the typical worker has less buying power now than a year ago. Some economists have pointed to the fact that measurements of longer-term inflation, such as the 10-year break-even rate, show prices will moderate back to more normal levels due to the Fed hiking rates to get prices more under control. Unfortunately, that does little to aid struggling Americans. If inflation is going to come down a year from now, that's not particularly helpful to average consumers today, said Melissa Brown, the global head of applied research at financial intelligence firm Contigo. There's reason to hope that the Fed won't overreact and put the economic recovery in jeopardy. For one thing, said Adam, the Fed is a transparent institution that just spent months talking about tapering. The idea that they'll suddenly take a hard money turn is out of character. They're going to be more pragmatic, Adam said. There's decent chance inflation comes down on its own. Consumers may continue to shift their spending from goods to services, like restaurants and vacations, as Omicron cases fall. At the same time, year-over-year price comparison will soon reflect the large surge that began last spring. This is